Investor sentiment has taken a nosedive, according to a new report released by CJ Patrick and RCN. In today's episode, we'll unpack how investors are feeling about the market and what they expect to happen in 2025. I'm Kathy Fettke, and welcome to the RealWealth Show.
You're listening to the RealWealth Show with Kathy Fettke, the real estate investor's resource.
Today, I'm sitting down with Rick Sharga, founder and CEO of CJ Patrick. Rick is a specialist on the economy, housing market, and foreclosure trends. Today, we're diving into a report that CJ Patrick and RCN just released about investor sentiment. We'll cover how investors are feeling about the housing market, the biggest roadblock for investors, and what impact the Trump administration could have on the housing market. Also, make sure to stick to the end because I asked Rick about the housing market and which markets will be the hottest for 2025. So let's bring on Rick.
Nice to be here, Kathy, as always. Happy New Year.
Happy New Year to you. Tell us about the investor sentiment survey that you just came out with.
Yeah, we've partnered with RCN Capital, who's a private lender. And it makes a lot of loans to individual and smallish investors to do a quarterly survey and gauge investor sentiment across the country. So the winter survey we just completed is the sixth iteration of that. And typically we're getting a pretty good handle on what the mood is among people who are fix and flip investors or who invest in single family rental properties across the country. So it's been an interesting undertaking over the last couple of years, and often we find some pretty interesting insights in the process.
Do tell. What are some of those interesting insights?
Well, we had a huge fall off in investor sentiment after 4 consecutive quarters of pretty steady growth in terms of optimism. We had a 27-point drop between the third quarter and the fourth quarter of 2024. And I think a lot of that was probably tied to market conditions. When we took the survey in the third quarter, we had seen mortgage rates and financing costs drop to the lowest level they'd been in a while. Since then, those rates have steadily increased. I think investors have started to see a little bit more competition from traditional home buyers trying to come back into the market. Home prices continue to increase, which makes things a little bit dicey. And for rental property investors, while this isn't true universally, we know it's been a little bit harder to raise rents on a year-over-year basis as more inventories come to market. So market conditions probably played a pretty big role in that drop off in in investor optimism quarter over quarter.
So the people that you are interviewing, are these mainly residential investors, 1 to 4 unit, or are they commercial, 5 units and more?
No, they're primarily individual investors who are buying those residential units, the single family properties, or the 1 to 4s. I'd say probably between 85 and 90% of the respondents are people who own or buy 10 or fewer properties a year. And we do have some larger investors who make up a smaller percentage of the respondents. But this is your classic mom and pop investor, the people that own 90% of the single family rental properties out there. And we think really is pretty representative of the overall market.
And this is for buy and hold or flipping, wholesaling? Is it specific?
Great question. It depends on the quarter. So this particular quarter, almost half of the respondents were rental property investors, the buy and hold folks. That's the first time in about 4 quarters where they've outnumbered fix and flip investors. And wholesalers have generally made up about 20% of the respondents. That's been pretty steady quarter over quarter. But the variance between fix and flip investors and rental property investors, we do tend to see go up and down a little bit depending on the survey. And by the way, that's one of the other reasons I believe the survey results this time showed a little bit less optimism. For whatever reason, and this has been pretty consistent, rental property investors seem to be less optimistic than fix and flip investors. when they respond to this survey, and that's both in terms of the state of the current market and their outlook going forward. So even if by and large they tend to all be optimistic, the rental property investors, for some reason, seem to be less optimistic than the flippers.
Interesting. Yeah, I was just going to ask that if there was a difference between the two. At RealWealth, we mainly represent buy and hold investors, and we've actually we just had one of the best months ever in December, which is so shocking because we know interest rates aren't the reason, right? They've been pretty high. So there's at least within RealWealth, we're still seeing a lot of optimism there. So it's interesting. I wonder, do you have an idea why they might not be as optimistic?
I think it comes down to market conditions. If it's harder to get an increase in asking rents at the same time that property acquisition costs are going up, both in terms of the property prices and finance rates, that all by itself is enough to kind of dim your optimism a little bit. But we also see some ancillary reasons like insurance problems. Before we started recording today, we were talking about some of the insurance issues in the state of California. But if you look at the state of Florida, really the number one issue raised as a challenge by a lot of these investors was the rising prices or the limited availability of insurance. And that's really more of a problem for a buy and hold investor than it is for a flipper who's not going to have the property that long. So I really do think it comes down to market conditions. And I want to be careful not to overstate this. The majority of buy and hold investors either see the market conditions as better than they were a year ago or the same. So it's not like most of them think things are worse. It's just on the whole, they tend to be slightly less optimistic than those fix and flip investors when asked the same question.
And I could see why that would be given where we are in the world. I mean, if you're comparing to just a few years ago, yeah, it's not as good, right? But it depends on which angle you look at it. A couple of years ago when interest rates were low and prices were still lower than they are today, there was massive competition. So you had that to deal with. At least today, you're not fighting against 90 other investors trying to get the same property.
No, and when we ask investors what their biggest challenges are, typically the top three have pretty consistently been the high cost of financing, rising home prices, and limited inventory of properties available to buy. When we first started this, there was a little bit more of a concern about competition from bigger investors. But that's kind of settled down into the maybe fourth or fifth challenge that gets mentioned, and very often we actually see more concern about competition from consumers, from traditional home buyers, and that makes sense because I think we've all seen that a lot of the big institutional investors are kind of keeping their powder dry right now and are on the sidelines or are shifting their focus toward build to rent projects and not competing so much for those individual properties with smaller investors. So it's just interesting to see what people's perspectives are, whether or not they actually reflect current reality.
Absolutely. So looking into 2025, are they thinking that it's going to get better under the Trump administration or worse? Well,
let's separate those two comments, and because I think there's some interesting subtext there going on. The speculation by both flippers and buy and hold investors is that the coming months will be better than where we are today. So there is some optimism going forward, and really that's universal. Whether you look at regions, whether you look at the nature of the investment itself, wholesaling, flipping, renting, they're all looking toward things being a little bit better. And they anticipate things like finance charges coming down, like home prices slowing down. About 35% of the people who believe home prices will continue to go up think they'll go up by less than 5%. So that's good for an investor, generally speaking, at least when it comes to acquisition costs. The reason I wanted to separate that question into two is because you raised the President Trump question. And we did ask some questions in this particular version of the survey about the president-elect's policies and proposals going forward, and found a decided lack of enthusiasm among investors about two of the president-elect's biggest proposals, which are high tariffs on imported goods and mass deportation of undocumented immigrants. And a very large percentage of investors have some concerns about those two policy proposals. When it comes to tariffs, the almost universal belief was we'd see costs go up for investors who need to do repair work or modifications to the properties that they buy. And probably because such a high percentage of construction workers are immigrant laborers and a relatively high percentage of those immigrants are undocumented, there are real fears that it'll be very difficult to find workers to build or repair these properties, and that the workers they are able to find are going to be more expensive, which will raise prices as well. So I don't know that the optimism about the future is necessarily tied into the incoming administration. Although, again, logically, you would sit back and say, okay, an administration headed by a career real estate developer should be likely to create a more friendly environment for real estate investors than the current administration did. And we do know that the Trump campaign has talked about not pursuing some of the things the Biden administration was looking at, like increasing capital gains taxes, like limiting the number of properties that an investor could own without losing tax benefits. So theoretically, we should be seeing a more investor-friendly environment going forward, but I'm not sure the individual investors have quite got their heads around that yet.
Yeah, if I were a gambling woman, I would say that probably the Trump administration is going to be aware of what real estate investors, want, because I would think he would want that too. All right. Well, we shall see, right? Only time will tell.
Along those lines, though, Kathy, there were some things that the Trump campaign talked about that are real estate investor oriented that definitely were of interest among the investors. For example, the idea of making government land and buildings available for development was really kind of a hot button issue with both rental investors and flippers. So that was very appealing. The notion of removing or at least reducing unnecessary regulations got pretty high marks. And interestingly, one of the highest scoring ideas that was discussed during the campaign was finding a way to incent builders to create more affordable housing units. And for one reason or another, the investors that we surveyed really liked that idea a lot. So maybe from the notion that, a rising tide lifts all boats or something, but there were some ideas that were discussed during the campaign that investors liked.
Yeah, that selling national land? Yep. Yeah, makes so much sense. So we'll see. All right. So aside from the survey, you are just an expert in the economy, in real estate, being able to pull out your crystal ball and see what's coming. So if you don't mind, I'd like to just ask you a few questions that would survey you. Let's talk about mortgage rates. I know it's almost impossible to predict where mortgage rates are going. Most people have said they're going to kind of stay where they are and not really go up much or down much. What are your thoughts?
Yeah, I'm going to give you a different answer than I would have given 6 months ago or 12 months ago.
Okay, let's hear it.
I do believe, and maybe this is me being hopeful, but I do believe that mortgage rates will come down slightly by the end of the year. But I'd have to emphasize the word slightly. I, at one point, was hopeful that we'd see them get down to 6% or even a little bit lower. I just don't see that as very probable for the rest of the year. But I could see us getting down into the mid or even low 6% range if circumstances present themselves appropriately. And I think the biggest issue we have right now is that the bond markets are kind of inflamed at the moment. They're worried about a growing national deficit, which is already at $36 trillion. And the Treasury needs to issue more bonds in order to pay down that deficit. And the more bonds you issue, the higher the yields you have to offer in order to get people to buy the bonds. And those bond yields are what drive mortgage rates. So if the administration, the Trump administration, is successful at convincing people that it'll be able to start to tame that deficit a little bit, we might see the bond market settle down, and we might see mortgage rates come down a little bit. But right now, I'd say 7% is probably the safe bet. And if we get down to 6.5% by the end of the year, we should probably all be grateful.
Yeah, it's so interesting. We've been talking about this for decades. And like, at what point is the world going to realize we need to cut spending? We can't afford all of this. And yet, how do you do it? So
that was probably the only issue that Vice President Harris and President Trump agreed on during the campaign was they wanted to spend more money. And that seems to be a common refrain in Washington right now. But yeah, it's crazy. And we are burdening future generations with just a ridiculous amount of debt. Right now, I don't think people realize this, but right now, paying the debt, interest payments on the debt, are the second highest federal government expense. We're spending more on interest payments than we spend on the military. So it's just an insane amount of debt. And we all know that a lot of the funds that go to Washington get wasted. And so I'm hopeful that this newly created Department of Governmental Efficiency will at least shine a light on some of this stuff. And we can start to spend less money wastefully for the taxpayer.
Yeah, no one wants to see cuts. I mean, we do, but whoever's getting cut doesn't want to see that. Right. And yet, someone's got to do it. Might as well be Trump. All right. So it's been confusing. I asked this in my last interview with an economist, and I still am trying to understand how there's this conflict where, on the one hand, a lot of people agree that Trump is going to grow the economy. And that usually leads to inflation and higher interest rates. And yet I also hear people saying what you said, where yes, but the Fed is going to cut rates a few times, maybe even more than a few times. How do those two things go together? How do you have growth, but then lower rates?
Yeah, I don't know that I have an easy explanation for that other than it's Washington, D.C. and nothing makes sense. I think you go back to the last administration, the last Trump administration, and you look at that as maybe past being a prologue. And during that administration, the economy did grow and interest rates were relatively low. They weren't as low as they went during the zero interest rate Fed program during COVID. But we had lower interest rates than we do today, and we had a growing economy. So I think
it's possible.
The other reality, though, Kathy, is that the Fed cutting. I don't think the Fed's going to cut rates a lot in 2025. I think if we get 2 rate cuts this year, it probably wouldn't surprise me that was it.
Yeah.
And the only reason that's likely to happen is because the Fed raised the rates so high in the first place in order to get inflation under control. So if we don't see inflation really bubble up in a meaningful way, they have that wiggle room to be able to come in with a couple nominal rate cuts, which really won't have an effect on the mortgage market anyway, but could at least theoretically reduce overall borrowing costs across the country.
Okay, yeah. So, and that's been my comment too. Is what he did it before. He threatened tariffs. He threatened all these things last time, but we still didn't see high inflation under Trump. But we did see growth. So, good answer. I like it. Okay, and then let's talk another thing. You seem to have your finger on the pulse of different markets within the U.S. that are maybe oversupplied, where maybe rents are going down or rents are going up. What are you seeing now and for 2025 in terms of where someone like me would want to buy real estate?
Well, I can't tell you where to buy, but I can give you some trends. Interestingly, two of the states that had been the fastest growing and still are in terms of inbound population, Florida and Texas, appear to be slightly overbuilt all of a sudden. There are only a handful of states where the inventory of homes for sale today is higher than it was prior to the pandemic. And Florida and Texas are two of those states. And we're actually seeing year over year price declines in some markets in those two states. So property values appear to be coming down a little bit in some of those markets where either we have a little bit of overbuilding or a little bit too much supply coming to market. Maybe home builders or home sellers got a little too optimistic there. We're seeing home prices increase more rapidly in the Northeast and parts of the Midwest, where there's just not an awful lot of supply. So, and then you have markets, coastal markets on the Pacific Coast in particular, where you see different micro trends. So, for example, where I am in Orange County in Southern California, prices continue to go up. If you go up to the Bay Area, you're seeing some markets where prices are coming down. So it really depends very, very much on what's going on locally. A lot of it's supply and demand based. But there are some extraneous factors that are starting to come into play, or ancillary factors. In Florida, the Gulf Coast part of Florida in particular, you've seen insurance rates skyrocket. Nationally, insurance rates for homeowners have gone up about 52% over the last 3 years. But in Florida, you're seeing markets where those rates have doubled or even tripled in the last year. And that makes affordability an issue for people looking to buy these properties. And that's causing, I believe, some churn in terms of property values as well. So we do still see people moving out of California, moving out of New York, moving out of Illinois, looking for lower cost markets. A lot of young professionals who simply can't afford to buy a house in some of those areas, looking to become homeowners, and they have portable jobs, so they're moving somewhere less expensive. So I still think the South, the Southeast, parts of the Midwest are good opportunities. We're still seeing people move into those regions, and we're seeing property values that are holding up reasonably well. But be careful about some of those previously high-flying markets in places like Florida and Texas.
Okay. Yeah, great. It makes a lot of sense because there are certain areas that builders just didn't build. What are some of the markets that are growing faster? Is it like?
Believe it or not, there are places in Ohio.
I was going to say Cincinnati, maybe Cleveland.
Cincinnati, Columbus is red hot. But Indiana, we've heard a lot of discussion about recently. So there are places. The Carolinas have been hot for the last couple of years. Tennessee's been hot for a number of years now. It'll be interesting to see how this all shakes out. I think the preponderance of extreme weather events and natural disasters that we've had over the last 6 months may skew things a little bit, and might actually slow down new home construction for a while, because a lot of the people that would be building new homes are now going to be dedicated to rebuilding homes that were destroyed by hurricanes or wildfires. So, there's a lot of moving parts in this market, as always, Kathy, but maybe more moving parts right now than usual. So really hard to predict with any degree of certainty.
Yeah. We just were looking at a project in Fort Wayne, Indiana. For that reason, there's just no new homes, and there's strong demand. So, all right, Rick. Well, always a pleasure to have you here on the Real Wealth Show. Thank you so much.
Always a pleasure to do these with you, and look forward to doing some more in the future.
Sounds great. And thank you so much for joining me here on the Real Wealth Show. If you want to hear my housing forecast, there's still a couple of tickets left for our upcoming Passive Wealth Expo. I'll be speaking, giving my forecast. My hubby, Rich, will be giving his Focused Investor Seminar. This will help you get really focused on how you want to build your portfolio for 2025. And then we're flying in 10 different teams from around the country, people from those Midwest markets that are so hot, and also the growth markets of Florida and Texas. And believe me, we know how to get into the areas where we're seeing rents rise, not decrease. So if you want to meet property managers from those different areas and property providers, builders, just join us at our Passive Wealth Expo. Just go to passivewealthexpo.com. There's just a few tickets left, I think 5 to be specific, and I hope to see you there.
views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.